Greetings from Finstudyclub. My name is Ankur Kulshrestha, welcoming all viewers to a very interesting, complicated, and sometimes confusing, concept of revaluation model versus the fair value model. Both these models we use in IFRS for different categories of long-lived assets. Therefore, my request is, before looking at this video, it is better to look at reval model and the fair value model as a prerequisite. Before moving to the finer details, I wanted to set the context for the current session, wherein the revaluation model, you would recall, is used for IFRS for properties which is held for use, whereas the fair value model is one which is applicable for the investment property, typically long-lived assets which is held for rental income as well as a capital gain later upon. It's going to be a very small session. We are going to talk about the fair value and the revaluation model, which are applicable only under the IFRS. What are the differences and similarities? Now, there are two basic aspects: the balance sheet, which is the asset valuation, and the recognition of the income. So my point number one is actually a similarity, which says that under both the methods, the long-lived assets that we are going to account for can and should be valued at the fair price. And also, I would like to tell that this value can go as high as an infinite value. There is no limit on the upward revaluation, so to speak. So there's absolutely similarity between the two. The only difference is in the second point, that too in the second part. Let's look at that. It says any change in the fair value needs to be taken to the income statement. Now my fair value model says that any kind of change, be it above the historical cost or below the historical cost, in any manner needs to go to the income statement. However, my revaluation model differs here. It says that anything up to or below the historical cost. Now this is where we had explained the concept of a diagram in my session on revaluation model, wherein we had said that anything above the line goes to OCI and anything below the line goes to the income statement. So my reval model says that OCI comes into picture. There is no PAT above or below the line. No PAT when we are recording any change in the upward territory. Okay, I'm sure that we need to do a quick example for that. A building was purchased by Apple Incorporation. This is the same example which I have been using, just for the consistency purpose, in my reval model video as well as my investment property video. It says that the market value on different dates was so and so. We need to compare, the financial statements using both the models. So I have a little bit of construct already there for you. I want you to pay very close attention to the similarities first. So in the both revaluation as well as the fair value model, we said that the market valuation will be used for balance sheet purpose. So in all the cases, my balance sheet value will be absolutely similar to each other, and in any case it is going to be equal to my market value. So that's my first similarity. Let's take every case one by one. It says that in 2012 an asset which was purchased for 10 has gone up to 13, which means my asset goes up by 3. Therefore my capital also needs to go up by 3. The question is, which part of the capital needs to go up? I am introducing a diagram here which I have used in revaluation model, which says that from 10 I have moved to the upward territory of 13, which is as per the revaluation model needs to go to the OCI. However, that's my point, that in case of fair value model, although A is equal to L plus C will be similar, the only thing is there is no OCI in case of fair value. Any change, whether above the line or below the line, will go to the income statement. Let's just continue this example for the second year as well. It says that the value has dropped down by 1.5, so my value of 13 has gone down to 11.5. I'm still above the line, therefore this change also needs to be incorporated in OCI. However, while my A is equal to L plus C will remain absolutely similar to the above, my change will not be reflected in OCI, it will be reflected in income statement. So this is what I meant by the difference, that for changes above the historical cost, the changes above the historical cost are to be reflected in OCI in case of reval model, whereas in case of fair value, any kind of change needs to go to the income statement. Moving on to the third year, which is again going to be one of the similarities now, we need to look at carefully. The value from 11.5 have gone down by 3.5, so that's the change in asset as well as capital. Only thing is, from 11.5 you have dropping down to 8, which means 1.5 is the change above the line, needs to go out of OCI, and $2 million is a change which needs to go to the income statement. However, in case of fair value, entire change needs to go to the income statement, and A is equal to L plus C absolutely remaining the same. So again, like I said, the market valuation, the change in the asset will absolutely be the same. Revaluation model says either income statement or OCI. In any case, it will impact the comprehensive income. My fair value model also talks about the income statement, no OCI, that means a comprehensive income. So I have to conclude one important point, that the comprehensive income or the equity as a whole remain absolutely same. It is the ingredients of the equity which might differ between the two. Now, in the last year, my assets value have gone up by 1, so has the capital. Only thing is, this is still below the line. In case of my below the line items, you would recall that below the line items, your income statement is impacted, which is absolutely the similar point. So therefore, my change of +1 and my change of +1 here. So while A is equal to L plus C, like we know, will remain same. So this is very simple, example to explain a little confusing concept. Just stay focused. In case of revaluation model, there is something known as an OCI which comes into picture. However, in case of fair value model, there is no OCI at all. If at all there is anything, that is P&L or income statement. So I hope that this very small session on revaluation versus fair value model, both of them are applicable in IFRS, is helpful, and I look forward to speak to you in my forthcoming sessions. Should you have any query, doubt, question, I would be more than happy to help. This was Ankur Kulshrestha signing off. Thank you very much.